The clock is ticking. And I'm not being dramatic here. Something is happening in the precious metals market right now that hasn't happened in over 50 years. And if you don't understand what's unfolding this week, you're going to wake up next month wondering why gold just added another $1,000 to its price tag while you were sitting on the sidelines. Let me paint you a picture of what's happening right now at this very moment in the global financial system. Central banks around the world are buying gold at a pace that's frankly terrifying if you understand what it means. We're talking about 220 tons purchased in just one quarter. That's a 28% increase from the previous quarter. These aren't small countries hedging their bets. These are major economic powers making a statement about where they see the future of money heading. And here's what nobody's talking about. When central banks buy gold at this pace, they're not doing it because they think it's a good investment. They're doing it because they've seen something in the data that terrifies them. They have access to information you and I don't see until it's too late. They're looking at debt levels, currency debasement, geopolitical fractures, and they're making a decision that gold is the only real money left standing. Silver hit another all-time high this week. Let that sink in for a moment. While everyone's been focused on gold's record-breaking run, silver has been quietly staging one of the most explosive rallies in modern history. And if you understand the gold-to-silver ratio, you know that when silver starts moving like this, it's not just following gold. It's telling you that industrial demand is colliding with investment demand in a way that creates the perfect storm for a supply crisis. Think about what silver is used for. Solar panels, electric vehicles, electronics, 5G infrastructure, medical equipment. Every single trend that's supposed to define the next decade requires massive amounts of silver. And unlike gold, which mostly sits in vaults, silver gets consumed. It gets used up in manufacturing processes where it's not economically viable to recover it. That means every ounce of silver that goes into a solar panel is essentially gone from the available supply forever. Now layer on top of that the investment demand. When people start waking up to inflation, when they start seeing their purchasing power erode month after month, they don't just buy gold. They buy silver too because it's more accessible. You can buy an ounce of silver for around $30 to $40. That's within reach for most people. But when millions of people start thinking that way at the same time, and they're all trying to buy from a supply that's already stretched thin by industrial demand, you get shortages, you get premiums that explode, you get delivery delays that stretch from weeks to months. I want you to think back to 1971 for a moment. That's when Nixon closed the gold window. That's when the United States officially severed the last link between the dollar and gold. At that moment, gold was trading at $35 an ounce. Within 9 years, it hit over $800. That's not a typo. Gold went up more than 20 times in less than a decade. And that wasn't because people suddenly decided gold was pretty. It was because the market realized that without any backing, without any constraint, governments would print currency until it became worthless. We're living through that same moment right now, except it's happening in slow motion so most people don't see it. The Federal Reserve's balance sheet has exploded. Government debt has reached levels that would have been considered impossible just 20 years ago, and every major economy in the world is playing the same game, printing money and hoping they can keep the plates spinning just a little bit longer. But here's what's different this time. In 1971, most of the world still trusted the dollar. The United States was the dominant superpower, and there wasn't really an alternative. Today, that trust is fracturing. Countries are signing trade deals in their own currencies. They're building payment systems that bypass the dollar entirely. The BRICS nations are openly discussing alternatives to dollar dominance, and every single one of those countries is buying gold like there's no tomorrow. When you see that kind of coordinated behavior from central banks, you have to ask yourself what they know that the general public doesn't. These are institutions with teams of economists, access to real-time data, and relationships with every major financial player in the world, and they're all making the same bet. They're betting that gold is going to be worth significantly more in the future than it is today. They're betting that the current monetary system is living on borrowed time. Let me tell you about something that happened in 2008 that most people have forgotten. When Lehman Brothers collapsed and the financial system was teetering on the edge of complete meltdown, gold didn't immediately spike. In fact, it dropped initially because everyone was scrambling for cash, for liquidity, for anything they could sell to meet margin calls. But then something interesting happened. Once the dust settled and people realized that the solution to a debt crisis was going to be more debt, more money printing, more quantitative easing, Gold went on a tear that took it from around $700 to over $1,900 in just 3 years. We're in that same setup right now, except the numbers are bigger. The debt is bigger. The money printing is bigger. The geopolitical tensions are bigger. And the number of people who understand what's happening is bigger too. That last part is crucial because it means the move in gold and silver is going to be faster and more violent than it was back then. Information spreads instantly now. When people see gold breaking records, they don't wait weeks to react. They react immediately. And here's where the window I'm talking about comes in. Right now, you can still buy physical gold and silver at relatively reasonable premiums. You can still get delivery in a reasonable time frame. But that window is closing fast. When demand overwhelms supply, which is exactly what's starting to happen, premiums explode. Dealers run out of inventory. Mints can't produce coins fast enough. And suddenly, the price you see quoted on the screen and the price you actually have to pay to get physical metal in your hands become two very different numbers. I've seen this happen before. In 2008, silver premiums went from $2 or $3 over spot to $8 or $10 over spot almost overnight. People were paying 40% more than the quoted price just to get their hands on physical silver. And that was during a time when most people still didn't understand what was happening. Imagine what happens when the mainstream finally catches on, when your neighbor starts talking about buying gold, when financial advisors who've been dismissing precious metals for years suddenly start recommending them. That's when premiums go truly parabolic. Now, I want to address something that's probably on your mind. You might be thinking, but gold is already at record highs. Isn't it too late? Shouldn't I wait for a pullback? And I understand that instinct. It feels counterintuitive to buy something after it's already gone up. But here's what you need to understand about gold. It's not a stock. It's not a speculative asset. It's money. It's the only form of money that survived every empire, every currency collapse, every financial crisis in human history. When gold is hitting record highs, it's not because gold is becoming more valuable. It's because the currency you're measuring it in is becoming less valuable. The dollar is losing purchasing power, and gold is simply reflecting that reality. So the question isn't whether gold is too expensive. The question is whether you think the dollar is going to regain its purchasing power or continue losing it. And if you look at the trajectory of government spending, the trajectory of debt accumulation, the trajectory of money printing, the answer becomes pretty clear. Let me give you a specific example of what I'm talking about. Right now, the gold to silver ratio is sitting around 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged somewhere between 50 to 1 and 60 to 1. And there have been times when it's dropped as low as 15 to 1. What that tells you is that silver is dramatically undervalued relative to gold right now. And when that ratio starts to correct, which it always does eventually, silver doesn't just catch up to gold. It outperforms gold by a massive margin. Think about what that means in practical terms. If you believe gold is going higher, and you believe the gold to silver ratio is going to revert to its historical mean, then silver has the potential to double or triple, even if gold only goes up by 50%. That's the kind of asymmetric opportunity that doesn't come around very often, and it's sitting right in front of us right now, while most people are still debating whether precious metals are even relevant in a modern economy. Here's something else that's not getting enough attention. The COMEX, which is the major exchange where gold and silver futures are traded, has been showing signs of stress. Open interest has been climbing while registered inventory has been falling. What that means in plain English is that there are more paper claims on physical metal than there is actual metal available to deliver. It's a fractional reserve system, just like banking, and it works fine as long as most people are content to trade paper contracts without ever asking for physical delivery. But what happens when that changes? What happens when a significant number of contract holders start standing for delivery? What happens when industrial users who need physical silver for manufacturing start getting worried about supply and decide they need to secure their own inventory? You get a squeeze. You get a situation where the paper price and the physical price diverge dramatically. And you get people who thought they owned gold or silver through paper contracts, discovering that when push comes to shove, they own nothing but a promise that can't be fulfilled. This isn't theoretical. This has happened before in other commodities. It happened with palladium. It happened with rhodium. And when it happens, the price doesn't just go up gradually. It gaps up violently because there's no supply available at any reasonable price. The people who own physical metal can name their price, and the people who need it have no choice but to pay. Now, let me talk about something that's relevant if you're thinking about your retirement, about your long-term financial security. A lot of people have significant wealth tied up in retirement accounts, IRAs, 401ks, accounts that have been growing for years or even decades, and most of that wealth is sitting in stocks and bonds, in paper assets that are completely dependent on the continued stability of the financial system. Here's the thing about those accounts. You can actually hold physical gold in them. It's called a gold IRA, and it allows you to get physical precious metals into your retirement account without triggering taxes or penalties. If you've got $100,000 or more in retirement savings, this is something worth understanding. I put together a free guide that explains exactly how it works, what the rules are, how to set it up properly. It's in the description below. No pressure, but if you're sitting on substantial retirement assets and you're concerned about what we've been discussing, it's worth 5 minutes of your time to understand your options. The reason I bring this up is because timing matters. Right now, you can still make these moves without competing with a stampede of other people trying to do the same thing. You can still get reasonable pricing. You can still get your account set up and funded without delays. But when the mainstream figures out what's happening, when financial advisors start recommending this en masse, the system gets overwhelmed. Custodians get backlogged. Dealers run low on inventory. And what should be a straightforward process becomes a nightmare of delays and complications. All right, let's get back to the bigger picture. I want to talk about what's happening in the physical market right now, on the ground, at the dealer level. I've been talking to people in the industry, and what they're telling me is concerning. Premiums are starting to creep up, delivery times are starting to extend, and most tellingly, the big buyers, the institutions, the family offices, they're not waiting for pullbacks anymore. They're buying into strength, which tells you they're not trying to make a quick profit. They're trying to secure a position before it becomes impossible to do so at any reasonable price. This is exactly what happened in the lead-up to gold's last major bull run. The smart money moved first, quietly, without fanfare. They accumulated positions while everyone else was still debating whether gold was relevant. And by the time the general public figured it out, by the time gold was making headlines every day, the easy money had already been made. The smart money was already sitting on massive gains, and the late arrivals were buying at the top. But here's the difference between then and now. Back then, gold went from around $250 to $1,900. That's a massive move, but it was starting from a relatively low base. Today, gold is already at record highs, and it's still going up. That tells you the forces driving this move are stronger than they were back then. The monetary debasement is more extreme. The geopolitical tensions are more severe. The loss of confidence in the dollar is more widespread. And silver is in an even more interesting position, because unlike gold, which is primarily a monetary metal, silver has this dual nature. It's both a monetary metal and an industrial metal. And right now, both of those demand sources are firing at the same time. You've got investors buying silver as a hedge against inflation and currency debasement, and you've got industries buying silver because they literally can't function without it. Solar panel manufacturers, electric vehicle makers, electronics companies, they all need silver, and they need it in quantities that are straining the available supply. There's a concept in markets called inelastic demand. It means that even if the price goes up, the demand doesn't go down because people need the product regardless of cost. Silver is increasingly showing inelastic demand characteristics on the industrial side. A solar panel manufacturer isn't going to stop making solar panels because silver goes from $25 to $50 an ounce. The silver cost is a tiny fraction of the total panel cost, and there's no substitute that works as well, so they keep buying, regardless of price. Now combine that inelastic industrial demand with elastic investment demand. When silver starts going up, when people see it making new highs, investment demand doesn't decrease. It increases. People see momentum. They see a trend, and they want to participate. So you get this feedback loop where rising prices actually create more demand rather than less. And in a market that's already tight on supply, that's the recipe for a true parabolic move. Let me tell you about something that happened in 1980 that's relevant to what we're seeing now. Silver went from around $5 an ounce to $50 an ounce in a matter of months. Now, there were some unique circumstances around that move involving the Hunt brothers trying to corner the market. But the reason they were able to push the price that high is because the underlying supply-demand dynamics were already tight. They just lit the match on a situation that was already primed to explode. We're in a similar setup now, except you don't need the Hunt brothers. You don't need someone trying to corner the market. The fundamentals alone are enough to drive a massive move. You've got supply that's been declining for years as mines get depleted and new discoveries become rarer. You've got industrial demand that's growing exponentially with the green energy transition. And you've got investment demand that's starting to wake up as people realize that inflation isn't transitory, it's structural. Here's what a lot of people don't understand about mining. When you see the price of gold or silver go up, you might think that miners will just produce more to meet the demand. But it doesn't work that way. It takes years to bring a new mine online. You have to find the deposit, which is getting harder. You have to get permits, which is getting harder. You have to build the infrastructure, which is getting more expensive. And you have to do all of this while dealing with declining ore grades, which means you're processing more rock to get the same amount of metal. The result is that supply is relatively fixed in the short to medium term. And when demand spikes, which is what's happening now, the only way the market can clear is through price. The price has to go up enough to either discourage some buyers or encourage some holders to sell. But when you're dealing with central banks who are buying for strategic reasons, and industrial users who need the metal regardless of price, and investors who are buying as a hedge against systemic risk, you run out of price-sensitive buyers pretty quickly. That's when you get the kind of moves that seem impossible until they happen. Gold going from 2,000 to 3,000 in a matter of months. Silver going from 25 to 75. These aren't predictions, they're illustrations of what happens when supply and demand get severely out of balance in a market that's relatively small compared to other asset classes. The entire gold market is worth maybe $12 trillion. That's less than the market cap of a single large tech company. When serious money starts flowing into gold, it doesn't take much to move the price dramatically. And here's the thing that should really concern you. We're not just talking about investment flows. We're talking about a fundamental restructuring of the global monetary system. Countries are actively working to reduce their dependence on the dollar. They're building alternative payment systems. They're signing bilateral trade agreements in local currencies. And they're backing up these moves by accumulating gold at a pace we haven't seen since the 1970s. This isn't a temporary trend. This isn't something that's going to reverse when the next Fed chairman gives a dovish speech. This is a multi-decade shift in how the world thinks about money and reserves. And gold is at the center of that shift because it's the only asset that every country, every culture, every economic system recognizes as having intrinsic value. You can't print it. You can't debase it. You can't make it worthless with a policy decision. Think about what that means for the price trajectory. If we're in the early stages of a global monetary reset, if we're watching the slow-motion collapse of the dollar-centric system that's been in place since World War II, then gold isn't expensive at $2,700 or $2,800 or even $3,000 an ounce. It's cheap. Because the endpoint of this process isn't gold at $3,000. It's gold at $5,000 or $10,000 or whatever number it takes to reflect the true debasement of fiat currencies. I know that sounds extreme. I know it sounds like the kind of thing that conspiracy theorists talk about. But look at the evidence. Look at what central banks are doing, not what they're saying. Look at the trajectory of debt and deficits. Look at the political impossibility of making the hard choices that would be necessary to restore fiscal sanity. And then ask yourself, what's the more likely scenario? That governments suddenly get religion and start living within their means? Or that they continue down the path of least resistance, printing money and hoping they can keep the system together just a little bit longer? The window I'm talking about, the one that's closing by the end of this week, isn't about some arbitrary deadline. It's about the recognition that we're at an inflection point. The market is starting to price in a reality that most people still don't want to accept. And once that repricing is complete, once gold and silver have moved to levels that reflect the true state of the monetary system, the opportunity to position yourself advantageously will have passed. You'll still be able to buy gold and silver, but you'll be buying at prices that already reflect the crisis rather than prices that anticipate it. You'll be paying premiums that reflect panic rather than premiums that reflect normal market conditions. And you'll be competing with millions of other people who finally figured out what's happening and are all trying to do the same thing at the same time. This is why the people who understand markets, who understand history, who understand monetary dynamics, they're not waiting. They're not trying to time the perfect entry. They're accumulating positions now, while it's still possible to do so without fighting a crowd. They understand that in a situation like this, being early looks the same as being wrong until suddenly it doesn't. And by the time it's obvious to everyone that you were right, the opportunity has already passed. So here's what you need to ask yourself. Do you believe that governments are going to stop printing money? Do you believe that debt levels are going to come down? Do you believe that the dollar is going to strengthen against real assets? If you answer no to any of those questions, then you need to be thinking seriously about how you're positioned, because the market is starting to price in a future that looks very different from the past 40 years. The time to act isn't when gold is at 5,000 and silver is at 100, and everyone you know is talking about precious metals. The time to act is now, when it still feels uncomfortable, when you're still not quite sure, when the mainstream is still dismissing the whole thing as a fringe concern. That's when the real opportunities exist. That's when you can still get positioned before the crowd arrives. The window is closing, not because of some artificial deadline, but because the market is waking up to a reality that can't be ignored much longer. Central banks see it. Institutional investors see it. The smart money sees it. The question is, do you see it? And more importantly, are you going to do something about it before it's too late?